Good evening, everyone. A very warm welcome to today's webinar on the Lollapalooza Effect in Investing Through Pricing Power. I am Ravindran from PMS Bazaar, and I will be your moderator for this session. Today, we will walk you through Ambit's new long-only AIF, grounded in a philosophy that values simplicity amidst complexity and focuses on enduring what hinders compounding. We will dive deep into how pricing power creates outsized outcomes, the essence of the Lollapalooza effect, and approach to uncovering quality businesses with durable growth potential. Stay with us as we explore how the right mix of quality, longevity, and discipline can unlock the magic of compounding. For exploring this, today we have our esteemed speaker, Mr. Siddharth Bothra, Executive Director and Fund Manager at Ambit Asset Management. Mr. Siddharth has over 25 years of experience in investments and equity research, and before joining Ambit, he had a long stint of over 18 years with Motilal Oswal Financial Services across institutional equities and asset management. At Motilal Oswal Asset Management, Mr. Siddharth was part of the core team that launched the active mutual funds, and he was instrumental in growing Motilal Oswal AMC's active mutual fund AUM from nil to INR 220 billion. Mr. Siddharth is an alumnus of the Indian School of Business, Hyderabad, which included an international MBA exchange program with New York's Stern School of Business. His strong belief in long-term compounding aligns with the flagship fund's mandate and Ambit Asset Management's investment philosophy, emphasizing quality and long-term goals. Welcome, sir.
Thank you so much. Delighted to be on this conference. Thank you.
Yeah. With that, we will begin today's session. Over to you, sir. You can go ahead with your presentation.
Good evening, friends. I'm delighted to get this opportunity to discuss about our new AIF, Ambit Pricing Prowess Fund. The key objective, if I were to, kind of explain for this fund, is that it's catered to what we call is probably the biggest segment today, which is investors looking for long-term investments, like niche investors looking for absolute focus funds. What has happened in the markets in the last 3-4 years in particular is that market has been in a very high beta, high risk on environment, and in such an environment, the focus on long-term quality investing has come off, and there's not enough. There are not many kind of alternatives for investors to invest in something which is really thinking long term and is focused more on an absolute return kind of a fund. So this fund would be focused on that. The second is that objective for this fund is we want to always maintain a prudent mix of offense and defense. What we mean here is that this would be an all-weather portfolio, which would try to be in a way prepared for facing black swan events, because when you think in long-term compounding, what really takes away long-term compounding is the advent of some kind of a black swan event which kind of impacts you on the drawdown. The third would be this fund is focused on growth, so it's a growth focused fund, and typically the fund would try to have a portfolio of 2025 forever kind of companies. And lastly, the way we are looking to kind of generate alpha here is by kind of removing the behavioral biases and the institutional imperatives which in a way impact long-term compounding. So to start off with, what is the big opportunity today? So if you look at the last 20-30 years, there have been two major macro tailwinds that we have faced both globally as well as also benefited from in India. One being the globalization trend, where countries have over the last several decades focused on where they specialize in, and hence global economy has benefited from it. The other being the benign interest rates. The rates have been on a continuous down cycle for almost like 20-25 year plus now. Both these now look like, if not a headwind, would may not be as strong a tailwind as it has been in the last several decades. The third being the disruption seems to be increasing every day. If you look at the company life cycles, they are turning shorter. So unless when investing, one is really going for companies with multiple moats where you have a visibility of longevity, investing and especially compounding could be a challenge. The other point being, it is our view that both globally as well as in India, given the kind of a return that we have seen, where we are sitting on multi years of up move market, our view is that on a next 2 3 year basis or in the medium term, what we are looking at is a lower return or a more muted kind of markets and increased volatility. So if you look at the volatility in last 3 4 years post COVID and compare it to the historical volatility that market has faced, we have been in an environment in last 3 4 years where volatility has been significantly lower than its long term averages. We believe that whenever market comes off from multiple years of up move and is faced with challenges both on economic growth front and also on the earnings front, then what happens is that typically volatility goes up and the return outlook in a way looks challenging. The last one is the key one, which is the that within entire this thing, I think India as a destination stands out. So we'll shift our focus to how is the Ambit Pricing Prowess Fund different, and in this discussion, we will start off by discussing on what is the key thing that we are trying to do. We believe that investing as such should be simple, but somehow it's been made more and more complex. And if you want to bring simplicity in this entire complexity, one of the ways to look at it is by eliminating whatever is impeding compounding. What we mean by that is long-term investing is nothing but understanding the magic of compounding. And if we can narrow down on key factors which impede long-term compounding and build strategies which would kind of help us impede those negative impact on compounding, that itself is a big advantage. So to start off, the number one differentiation for us is the mindset. I think majority of the market today operates in what we call the short end or the short term curve as such, where the views are taken more for like 3 months, 6 months, or 1 year. And this is the kind of a bucket where many people are trying to outperform or trying to operate in. And the moment you step back and take a view which is slightly longer term, say a 3 year, 5 year plus, you gain a significant advantage. So here, our view is more from rather than next quarter, we think more in next 5 years or next decade. The second point being there's too much focus on stock price movement and not enough on business fundamentals. So one of the key advantages for this fund is that we have a very well identified process, and what we are trying to do is simply follow the process as such. And this allows us to think more in terms of a very bottom up stock investing style, rather than be focused more on the stock price movement or more on the markets and what markets are doing. The third one is action versus thinking, which is what we call our approach. Our approach is, we don't believe that long-term investing can be done with, the whole focus is trying to do action on every basis. So if you look at the market today, there's too much premium being given on trying to react to every news. So if there's a war or if there's any kind of uncertainty, you will see people moving in a big way towards cash or taking a completely, defensive positioning. Similarly, when things look good, sometimes the risk positioning is at the extreme. We believe this kind of this is more a speculative kind of a thing in nature. And if you have done deep thinking enough when you're investing a company or when you're building your portfolio, I think that is more important than trying to react to every news now and then, because typically whenever you are reacting, you're behind the curve and it doesn't help. The fourth point being comfort of crowd versus independent thinking. We believe this is again a very important point, because a lot of emphasis is given on being around where there's comfort of crowd. So if for a particular reason a sector or a company has kind of there is a lot of talk about there being certain things, then the comfort of crowd is either being not in that stock, or if it is like the if it is like kind of the key the stock or the sector doing well, then everyone wants to be crowding around it. The If you can move away from that to more independent thinking, that is a behavioral aspect, you have an advantage. And lastly, the point we are making here is that whenever markets are at a a particular extreme, like think about the period from 91 to 94, 2003 to 7, or wherever you have seen multiple years of excesses in one particular segment, then to have a focus that you want to do relatively better in the same segment by doing what has been happening is a very high risk thing. Hence, during such time, the focus should move more towards having absolute performance, which will then allow you to, step back and not participate in segments or particular areas where you think there is excesses happening. So I will start off by discussing our first differentiation point, which is the mindset and how we can bring simplicity in this entire complexity. We do it broadly by 2 points. One is having a more infinite mindset, no finish line. So the moment you take away the focus from trying to game a very narrow term or very short term kind of a time frames, which is 6 months, 1 year, and so on, you, as we said, we get a big advantage. Now the point is, when you want to think about 5 years and 10 years, the focus has to be on longevity of growth. Growth itself, obviously, if growth is high, it helps. But the more important than high for us is the longevity of growth. So whenever you think of companies which have created really long-term wealth for investors, the aspect about it which is really surprising, or which allows it to do that, is the longevity of growth. And our investing style, which we call which is based on pricing power, we believe allows us to focus on such company and try and concentrate on identifying companies which have both longevity of growth. The second point is the process. Our process is pursuit of pricing power plays. Here, I would want to quote, one of the Warren Buffett's quote, which says that the single most important decision in evaluating a business is pricing power. If you've got the power to raise pricing without losing business to a competitor, you've got a very good business. So our entire pricing power framework is, in a way, what Warren Buffett has in a way kind of called out to be the most integral part when you're evaluating a business. So firstly, let us just define what we mean by pricing power, just for bringing everyone on one page. So pricing power, or a company's ability to raise prices and maintain profit margins amidst increasing cost or competition, is one of the most critical dimensions for evaluating the value of a business. We believe that enduring competitive advantages come from either sustaining relatively high prices or a lower relative cost, or both, than your rivals in the industry. So what we essentially look for is businesses where they have significant cost advantage. I'll give you some examples where you could see it. Say, if you take the case of Interglobe, or if you take the case of Avenue Supermart, or some of the manufacturing companies which have a cost which is significantly lower than the industry cost. The second one is typically companies which have a price advantage, where the strategy of the management is to increase the willingness to pay, or create buyer surplus. So companies here would be companies like, say, iShirt, Titan, companies like Abbott, and so on. So their whole focus is that how do they make buyers buy at a premium to what the competitors are selling, and hence their focus is differentiation, whereas the first is more on the cost side. And very seldom, like once in a while, say globally also, I can think of very few companies. Once in a while, you come across a company which, in a way, has advantage on both sides, because they follow a fit strategy. So not only do they have a cost advantage, but they also have a price advantage. So while some of the business model itself is like that, often also what you see, another thing that you notice is that in between sometime, like for a small period of time, like 2 years, 3 years, even if a company is from, say, cost advantage, or say a price advantage, they fall in this third category where they enjoy both the end. I will probably again give the same example. Like, let's take the case of Interglobe. Because the competition is so weak today, the company seems to be enjoying both the cost advantage, where their cost is significantly lower than their competitors. At the same time, on the price side, they are able to, though they are a low cost carrier, they are able to price as much as, or sometimes higher than a full service carrier. Now, this advantage on the price side may not sustain on a long term basis, because once the competitors get their supply of aircrafts, get their act right, then maybe they will the Indigo would not be able to kind of charge that premium. But while this period is on, they have all the two advantages. So now, why pursue pricing power plays in the first place? So one of the number one reasons is that pricing power plays act as an inflation hedge. Companies which have pricing power are able to shield their real earnings and shield investors from the eroding effect of rising inflation. The second is more critical. Typically, you will see that companies which have pricing power have a tendency to keep increasing their margin. So if you think in terms of what is a driver for a company, say the number one driver would be the volume growth, number two would be different segments and the price increase, and what is the revenue growth. The number three driver is typically what you call margin play. And the one thing that investors sometimes find very difficult to fathom is the kind of a delta that this margin improvement can do. While the top line growth, often analysts are able to kind of factor in, the margin improvement is a very difficult one. And the beauty of pricing power companies is that these companies keep increasing their margins, and hence there are three levers working in a company. The third point being, these companies are typically stable quality compounders. So often you will see these are very, they are not the glamorous kind of companies. They're not much in the news, and they keep compounding on the background on a very stable basis. So this is what you want when you want to kind of enjoy the benefits of compounding for your investing. The fourth one being resilience. This kind of a strategy works across globe, across economic cycles, and the cornerstone of such companies is that they are very resilient. And when you build a portfolio out of these companies, they turn out to be very high quality portfolios. And the last point on this is that typically, I mentioned to you that there are four drivers to a company price. Number one being volume, then the relative revenue growth, then the margin. The fourth one is the valuation. These companies, by impacting the longevity of the company, which makes basically number of years increase, which in a way making the volatility low, so which reduces your standard deviation, in a way helps increase the valuation. So the companies when you buy, which is just starting, or which is where pricing power is increasing, you are able to play on all the four levers of a company. Now, what exactly are we trying to do in this portfolio? What we are trying to do here is try to create the Lollapalooza effect that Charlie Munger talks about. And I'll just read out the first line of his definition for same, which says that the Lollapalooza effect in business is about getting multiple mutually reinforcing factors right. So both the words are important, multiple as well as mutually reinforcing factors right. So if you see what we are doing, pricing power in a way is nothing but just another way of looking at quality companies. You may have in the past heard of moat investing, where people look for moat and around the company, and they want to buy companies which have multiple moats. At the same time, you would have heard the Peter Lynch style of investing, where they look for companies with very strong brands, or companies in the consumer side where they think there's a lot of longevity. In the same way, what we have realized is that when you have many of these factors coming together, which is moats, the dominance, and the management who plays the long game, like we have six factors put here. When all these factors come together is when a company has pricing prowess. And when you build a portfolio of say 2025 forever or pricing power kind of companies, is when you are able to effectively create a Lollapalooza effect for your portfolio. So I will very briefly talk about some of this. And the second one, which is the key one, which we use to screen such ideas. The first is the dominant franchise. We are looking for companies which are dominant. Either, not necessarily everyone should be like a duopoly or oligopoly, but even if it's in a sub-segment, the dominant player, that's what we are looking at. The number two point is where our differentiation comes in, which is essentially very simple, which says that we look for companies which have advantage in the key consumer variable, which have very high variance. Now, what we mean there is that whenever we look at a company or industry, typically in any company industry, there are one or two variables which consumers weigh very heavily. The third, fourth, fifth variable the consumer doesn't pay much weightage to. So if you can find a attractive industry which is growing, and within that industry, if you find that the two three variables which are there, within that there's huge variance. Now what we mean by huge variance is that majority of the companies are very weak, and there are one or two which stand out as being very strong. To again maybe give you example of say retail. When you look at say someone like Avenue Supermart, the entire cost of operation, after your gross margin is around 6.5% odd. Whereas you look at most of the competitors, their rental cost itself would be above that, more like 7%, 8%, 9%. So they have a significant advantage in an industry which is very large, still growing, where the organized penetration is very low. And so this kind of a cost advantage can keep building. So as their scale increases, the advantage can keep becoming bigger. As the overall assets start aging, the advantage will become more and more attractive. Same we can say for say something like a very basic, like how do you choose on how do you choose say if tomorrow you want to go for a hospital, how do you would you choose that? The two three factors which will be very important for you, would you first look at, okay, who are the key doctors there? Does the hospital have all the key modern equipments? The third point would be the cost or the location. Now within that, because hospitals in a way is a local thing, unless there's something for specialized you're going out. uh, if in a particular area there is huge variance, that is some of the places are very very weak, whereas some players are very strong. So this is where we look for, and once we identify a few such company, we take them through the other screening, which includes looking for multiple modes, looking for management who are playing the long game. We try and avoid management who are very narrow term focused. We look for management who think 5 years, 10 year out. And the other point being quality first, and within that forward looking quality. So many investors have quality first as a key way to invest. But the differentiation we have is we believe that when we're talking quality, we are not necessarily focusing too much only on the backward looking nature of quality. But we want these companies to be improving on the particular aspect over the next 3 5 years. So if they have multiple modes, we want all the modes to be expanding. Similarly, if it's a pricing power company, we want the power to be increasing rather than being kind of coming back down over the next 3 5 years. So this is broadly how we do the screening for our companies. We give around 30% weight to quantitative factors and around 70% weight to qualitative factors, which in a way is something you can't just put numbers and screen. This is more an art. While the first one you could say is a little bit of a science, the second one is purely art, and that's where we bring our differentiation. And once we are able to kind of go through all the qualitative frameworks and kind of get it tested through the quant numbers, is when we then narrow down to companies which we think have pricing power. Now, what are the two key areas wherein we differ from say a normal quality focused house, or people who normally talk about quality investing? One of the things we have noticed is that quality investing by its very nature, which is very backward looking or static quality, ends up focusing on the gray shaded area. I'll just take a brief moment to explain this exhibit. This is nothing but the life cycle that Professor Damodaran explains. So just like a human being who goes from an infant to middle age to old age, even a company goes through the 6 stages, which is a startup, young growth, high growth, mature growth, and then starts declining. So when you put too much emphasis on the past performance and you index too much to the past, what happens is you often end up with companies in mature growth or mature stable segment, and sometimes you miss out on companies in high growth or the young growth phase. So these could be the industries which have come up in a very near term, like 5 7 years, or it could be companies where they've just got listed, don't have enough history, so they are essentially very young companies. Or third could be they could be fallen angels, that is great companies, but they fell into difficult times for a few years but are now coming back strongly. So this is our first point of differentiation. The second being focus on forward quality. So we talked about is that while the static quality is indexed to the past, We seek companies which will be successful over the next 5 to 10 years. We go beyond conventional wisdom, and by applying our pricing power framework, try to identify companies which will be more successful in the next 3 5 years. And the zone that we typically focus more on, is this late stage 2 to the beginning of stage 4 segment. This is the where we want our maximum companies to be. So when you look at most of the modern day discussion, the modern day discussion would be, should you buy large cap, should you buy mid cap, should you buy small cap? And a lot of energy goes between discussing this. But actually, the point is not whether you buy large, mid, or small. The point is in which life cycle of a company are you buying it. So even if you buy a small cap company, which essentially says 30 years, 40 years old, or 25 years old, and is small probably because it's a dwarf and not a child which will become a middle from a small cap will become a mid cap or a large cap. They may continue to remain small cap. So if you build a small cap portfolio of such companies, your portfolio will behave worse off than if I were to build a portfolio of a large cap stable or growth companies. So what we need is companies from all life cycle. We need companies in the young growth, we need companies in the high growth. Then it doesn't matter whether they are small cap, large cap, because a large cap here will become mega cap, a small cap here will become mid cap, and most of them will grow fast. So this is our main focus. Now, one of the thing which often happens is when people hear of pricing power, and the one of the assumption is that if pricing power is so pervasive, everyone knows about it, then either the companies are all expensive, or it is priced in, and hence your future returns may not be good. Now, any empirical study you do does not show that, because across geographies, across market cap, this strategy has been shown to create significant alpha over a long period of time. And the reason is that these company outperform because of two reasons I mentioned. One is the longevity. By longevity, what we mean is that typically the human mind can think of growth over next 2 years, 3 years. But the reason many investors missed out on buying companies like, say, HDFC, Kotak in the past, or Bajaj Finance, Aisha Page in recent times, and or so on, is because they could not fathom that these companies can grow at 20-25% for like 20-30 years and so on. They typically view that, okay, if company is done well for 3 years, then you should now look for the next HDFC Bank or the next Titan. So if you look at the jewelry industry, Titan has created so much wealth. But often when I ask investors whom I meet, or broadly many of the retail investors, that have you, like, because Titan's been doing well now for almost 20-25 years, so did you ever buy a Titan? Their view is that we saw Titan doing well, and we ended up buying some of the other companies which we thought would be the next Titan. So they would have bought, without naming companies, and those companies in the past have not done anywhere close to that. In fact, many of them have kind of destroyed wealth. So the idea is here that often what you think is obvious in front of you, you ignore, and you try searching for something new, which should not be the case, because investing is more about certainty. Now, the third differentiation is approach, where instead of placer mining, our focus is buying nuggets of gold. Now, what I mean by here is something which Warren Buffett again has given a quote and explained. He says that our investment approach is not that of placer mining, the process of shifting through piles of sand for specks of gold. Instead, we attempt to apply our pricing power framework to find the large, unrecognized nuggets of gold that sometimes lie in plain sight. Now, what we mean here is that many people approach investing as a treasure hunt. For them, investing is about finding some new idea or finding something which no one knows about. To us, investing is more like just picking up nuggets of gold. Most of the companies we have bought was visible to everyone, and they were like nuggets of gold which you just needed to pick up. So the risk element there was very little. To give you an example, if you go 6 months, 9 months back, most of the private banks were available at valuations which were even lower than the pre-COVID, and financials or BFSI is probably going to be one of the best performing sector over the next 15-20 years if the per capita income increases, or if the India story were to play out. But people didn't want to buy it because they felt that for next 1 year there's NIM pressure, or the earnings growth is not much. But the value of a company is not what's going to happen in the next 1 year. These companies, many of them had history of 35 year. Probably these companies will survive for another 35 year. So when you compare it to the intrinsic value, they were extremely cheap, and it's played out in the last say 6 months, 9 months. Many of these banks have given you, or insurance companies have given you 30-35% return without taking any kind of risk in a way, because they were buying them so cheap, and these are so sound as a company. So from an equity perspective, when I say any risk, what I mean is within the equities, this would be amongst the lower risk side. Now, similarly, there are many other companies like, let's take the case of Abbott. Now, Abbott has been doing better than, though it's a pharma company, MNC pharma company, which has got itself registered as a domestic company now. Even this company, along with the domestic companies, I mean, even this Abbott, is visible to everyone. All their brands is amongst the top one, two, and they keep growing at 10%. Their profits keep growing at 20%. Yet, there's very little talk about it. There's very little coverage on it, and the company has created so much wealth over the years. Or even say take case of some young growth company like Eternal. What Blinkit is doing in India, what quick commerce is doing in India, is in a way similar to what say happened in e-com globally. And people can draw parallels between what happened there, what happened here, but people often miss out. What I mean by miss out is that if you were to ask, say, the age group between 10 to 15, who will be the future consumers for us, as to which are the strong brands, that name the top 10 brands they know. Say maybe 15, 20 years back, the answers would have been, say, many of the FMCG retail companies and so on. Like, you would have started with Colgate, Britannia, HUL, Nestle. Today, the names would be very different. It will probably be some of the global names, or say, would be like, say, a Zomato or a Swiggy or a Blinkit. So you have to realize that, the whole, the brand side, the consumer strength, which was there earlier with some other brands, is now emerging in something else, and hence you had a ability to participate. Another thing I wanted to point out is that when you say nuggets of gold, people are like, what essentially do you mean? That how can you pick such companies? So often pricing power, people relate to this particular segment, which is, high longevity consumer brands. So for them, pricing power typically means companies like Titan, Nestle, say maybe Asian Paints, or so on, which over a long period of time are consumer facing and quote at a high premium or high valuation. And this is what they assume is pricing power companies. But pricing power companies can be very different. They can be non-glamorous, steady compounders like Crisil. So globally also, if you look, the best examples of pricing power companies is, say, the Mastercard, Visa. You think of S&P Global. You think of Moody's. These are some of the best examples of pricing power companies. You hardly hear much about them. They don't come on news. I mean, nothing about them comes about news every day, and they keep compounding. So whenever you look at these companies on a 3-year, 5-year basis, they would have like increased significantly. The second is hidden pricing power plays. There's some companies which have significant pricing power inherent in the business model, but have not been, kind of utilizing it. Like take the case of KFIN, take the case of HDFC AMC. What I mean is, let me explain by KFIN. It's a duopoly, and you would have heard of switching cost and why such companies have advantage. So this company does something which costs like point 0.4, point 3.5 paise for a AMC, but they take care of the entire backend side of managing customer expectation, giving them their statements, getting the NAV done, and so on. Now, for such a small cost, if a AMC were to do it on their own, their cost will be significantly high. And as they become bigger and bigger, the ability to do that suddenly is also less, because there's so much that they can disrupt. So while currently they actually are getting impacted because their margin gets impacted because there's a high growth happening in the sector, so they're not even utilizing their pricing power. But essentially the point is, if they want to, they have significant pricing power. The third being established pricing power plays where you don't hear much, like Aisha Motor, Abbott. The other being fallen angels. By what we mean by fallen angels is companies which are great sectors or great companies, but temporarily fell into difficulty, whether it be ICICI Bank 6 7 years back or Bharti some years back, where the entire sector went from some 10 12 companies to currently maybe 3 companies and so on. And then there are some misunderstood businesses which people don't understand. Like for a long time, people thought Eternal or Zomato was a loss-making company, or something was a bicycle company. They didn't understand the inherent advantages of those businesses and hence miss out. Then the fourth one, which I think is the very critical one, which we had talked about when we talked about the objectives of the fund, is the focus on risk. There's again a very old saying by Howard Marks, which goes like this, which is there are old investors and then there are bold investors, but there are no old and bold investors. Now, what we mean by that is that you as an investor have to decide what are you trying to focus on. If your focus is to achieve glory, then often the glory is more like a glory of a shooting star, where if what you're trying to do is maximize your return over next 2 3 years. What happens is you may have 1 2 good year, but typically this is more like a shooting star thing, and before the period also ends. So this is more like a sprint. Our belief is that anything worthwhile to be achieved takes time, and the beauty of such things which compound over a long period of time is that they gather a pace of its own. So we are looking like a snowball effect. We are trying to benefit from the magic of compounding, and we view investing more as a marathon rather than a sprint. I will try and explain this by what Howard Mark has tried to explain. So what he says is that whenever he meets investors, he asks them, "What do you want? Do you want to maximize your returns, or you want to make sure that your capital is protected?" And they are, as you would have noticed, on the opposite end of spectrums. And he says that most investors tell him that they want to do both. To which he explains them that both is not possible, because if you are on the extreme left, which is trying to protect your capital, then you will not even be able to make the basic risk-free rate, or not even be able to earn the ETF returns of a fund. Whereas if you are always trying to do a maximize your return maximization, and you operate too much on the right, which is you become too offensive in nature and investing style, what will happen is that any one black swan event or one call going wrong will probably put you back 2 3 years, or often take you out of the game itself. So the way we do it is we try and have a balance between offense and defense at all time. Why all time? Because many time people go risk off when there's a war in front, or there is something very negative happening, and during such time is when you should actually be buying. Whereas the market reacts in an opposite way. They create huge cash or take a completely opposite stance then. And similarly, when the outlook is very rosy, they end up playing here, which both is wrong. So we make an attempt to be more having a balance across all time, because our objective is to create long term money over 5 years 10 year, and not try to play the 1 year 2 year game. Now, the other one is the behavioral part, which is that conviction cannot be borrowed. Now, again, here I would want to read out one quote which says that choosing individual stocks without any idea of what you are looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. Now, what we mean here is that investors today, just like you do in large cap, small cap, mid cap, even for style, investors have particular buckets where they put investing, their investments in. They don't put everything in, say, one fund. So they have some funds where they put money because they believe that, here the money will compound, and the longevity is what they are playing. They may play something where they are buying only small caps or trying to play the high beta end of the market. So the beauty of a fund is you should remain true to what you're saying is, rather than try to chase what's happening in the market to be serving whatever needs, whatever is working at that time. Because when you do that, you are neither here nor there. So we have a strong conviction in quality and long term investing, and this is not a fad for us. So when we say quality, we don't do quality investing because it sounds good or it's a fad. We do quality investing because it's the basics of investing, and even maths would prove it. Like when you buy companies which are resilient, which have durability, and where there's longevity, and you buy it at a right price, you have a significant advantage over companies which are deep cyclical, which does not have resilience, or where management quality is in doubt. So then maybe just quickly to summarize, how do you think, how to think about long term investing in quality? Modern finance, or many the literature on finance, would make you believe the first exhibit that you see here, which is the return expectation. So they would make you believe that unless you take high risk, which is the x axis here, and high risk and then low quality is how you will earn high returns. Whereas if you buy very high quality, you may be high on quality, but your returns will be low. So this is what a typical modern finance theory would try and put it across. But this is so very wrong, because if you look at the second one, it will explain why it's wrong. Low quality, or LQ is called low quality, is because by nature it is low quality and most of the expectations are not met. So when you buy companies which are low quality, poor management, hoping it will do 40%, 50% growth and so on, what typically happens is the expectations here, but the delivery happens here. Whereas in high quality companies, what happens is your expectations may be very low, but simply because of the robustness of the business model, because of the optionality that sits in a company, because of the superior management quality, the actual delivery is much higher. So the reason you should buy high quality is because not only because it will be more resilient, you take less risk, is but because this is where you can earn higher returns over a long period of time. Because low quality by its very nature cannot give you higher returns, because if it could, then you wouldn't have called it low quality. So with this, I would just summarize it lastly by saying that, when you look at this exhibit, I told you the second part of my discussion is on why it's an up time. So if you look at this exhibit here, it's nothing but the difference of, 1 year excess returns of quality versus value. If you look over a long cycle from 2006, there are periods when value has done well, there are periods when quality has done well. So the period post-COVID for a long period has been a period where value, or the high beta, the so-called risk-on kind of a segment of the market has done much better. It is only now that we are seeing some subtle signs of quality coming back. So we think there will be a period where this will do significantly better, and hence the focus on quality style of investing. And this is where a portfolio like this will benefit. To again just step back and explain what we mean here, is that if you look at the period from say 2021, which is post COVID, till say September 24, or to some extent even say till the last month, what has happened is market was invariably in a mode of very high risk, high beta, deep cyclical, deep commodity. These were the kind of companies which were doing well. Whereas high quality, or quality style of investing didn't do well. Now there's reason why it didn't do well. One is obviously the very basic, the base effect. In 2021, when COVID hit, companies which didn't have quality, or which didn't have resilience, they had their bottom taken away. So they fell like as much as 50, 60, 70%. Whereas quality still held well. But on a recovery mode, what happened is obviously what you had written off as almost dead kind of a thing, when they come back, they suddenly, the government bailed out sectors. There was a global effort to bring up the stock market. So in that, they did very well over the next 2 years, 3 years, because the entire supply pipeline was zero. These companies were beaten down so badly. So you had a period between 22, 23 where not only earnings did well, but the valuations also went up, and many of these companies did much well, versus say a quality which had not fallen much, and hence on a recovery only benefited that much. But the period we saw 1 year after that, between 23, 24, or now, what we are seeing is, while earnings growth has again become muted for the broader market as such, or for such companies where you don't have quality, or where it's deep cyclical, or not, some of these companies where growth is transient, the valuations have gone sky high, which is not sustainable. But because everyone's chasing this segment, like everyone wants to be investing in Smith today, the liquidity itself is probably letting some of these float, or letting some of them keep going up. So with this, I would want to quickly conclude my presentation on this and just take 2 minutes to conclude, which is the belief is that we are moving in an environment where market will become from broad-based to concentrated. There will be a move more towards quality, more towards companies which have resilience, durability, which would mean to some extent more large cap also. And in this kind of environment, the product we have is where we think you will create better long term returns over the medium term or even on the long term basis, because quality or this kind of investing on a long term creates superior returns. With this, I'll hand it over. Happy to take any questions that you may have.
Yeah, thank you, sir. That's a wonderful presentation, sir. We didn't even notice how the time has spent, sir. The presentation was that much informative. Yeah. Dear participants, the forum is open for Q&A. You can post your questions in the Q&A box. Yeah. Before moving on to the audience question, I have a couple of questions to ask you, sir. So, given we are facing a lot of turbulence and disturbance across the markets, like tariffs and due to war-like situation, what is your current outlook on Indian equity markets, sir? Do you see our current valuations as justified, or how you look at it, sir?
So my sense is our house view on this is that the market return in the near term looks muted. We believe that the earnings growth, when you look at it over the next 2 years, is going to be more like in the low double digits. Whereas valuation, when you look at the broader market, whether it be mid cap, small cap, is like between 1.5 plus standard deviation away, and so they have room to kind of correct a bit. So the overall returns look like on a good basis, maybe like a double digit or less. So this would be a difficult market overall. But what happens in such markets, or more particularly in India is a very bottom up market. So this would be a market for very much for stock market, for stock pickers, and those who are good at stock picking, their return outlook could be very different, because even in a scenario where things are difficult, there are some pockets of the market or there are some particular companies which really stand out. And when your strategy is very bottom up oriented, picking as a stock picker, your overall performance could be different from the overall average market performance.
Yeah, understood, sir. So, are we entering a new cycle in global liquidity, and how will that affect emerging markets like India, sir?
So I think liquidity has been one of the key, factors which have kind of driven both the global markets and Indian markets. As we started off by saying, we think this factor going forward cannot be a very major driver or a major tailwind for the equity markets. In a way, we think not only will it subside, but at some point in the next 6 months, 9 months, they could start acting as a headwind for the market itself.
Yeah, got it. So, when you say multiple increasing modes for a pricing power company, what are the types of modes you typically look for, sir? And how do you track if they are widening or decreasing?
So if you look, Charlie Munger in his book, has identified modes into five key particular ones. He actually puts network effect as the most strong one. Then he comes to brands. Then he comes to some of the other factors, which the least one is like say a patents, or you have some kind of a government license or something, which is the least strong brand. So amongst these five, where we focus more on is companies which have network effect, companies which have brand advantage, companies which are benefiting from switching cost, which I talked about, very low switching cost, and very high switching cost, and companies which supply something which is very small proportion of the price for the buyer, but in terms of impact is very significant. So these are the ones we choose. Now, when you say how do you track the whether the moats are expanding or not, you have to look at leading indicators and also to some extent some of the backward looking indicators. So some indicators like what's happening on the market share, what's happening on their margin vis-a-vis the peers and so on. And so these are some of the things which give you lead indication as to where the market is headed. And that's what you have to be focused on to make sure that the moats are expanding. So typically a company which has an expanding moat would see his margins expand, would see his market share moving up, would see his margins and returns to be superior than not only the peers, but maybe often case the definitely against the industry benchmark, but even sometimes the best peers and so on. So those are the factors as when it's working in the right direction, gives you a sense that it's moving in the right direction. Like if you look at many of the companies which were known as very high quality in the past, if you've seen the derating in some of the industries today, like let's take the case of paints or something, what's happening there is you can see that the moats are instead of expanding is shrinking, because competitive intensity is increasing. The nature of competition is increasing from differentiation innovation to very price led kind of a thing. So you have to be on a lookout for what's happening on the competition side in a big way. And this is what an active fund management is about.
Yeah, interesting to know, sir. So, how do you define and measure pricing power in a business or sector where pricing is regulated or commoditized, sir?
So there you will often see that pricing power comes in the form of cost advantage. Wherever business is in a way very commodity. Like if you take the case of say, Interglobe, it's a very commodity business. Everyone has the same aircrafts. They fly from the same airports. Everything is very commodity oriented. But within that, then you have to look at who has the maximum cost advantage. Because it's very difficult to in a commodity business benefit from differentiation, to be able to say that I'll be in a commodity business but I'll make others pay a premium. There is some element of that, like even in a cement, which is to some extent you can say is a commodity. You will have companies which are focusing on grade A market, the retail market. There's some who are focusing on the institutional market or the grade C market. So the prices are very different. So even that small change gives them big advantage. But typically cost advantage here is more important than the differentiation advantage that some companies have.
Yeah, got it, sir. So, your investment framework heavily weights qualitative factors, sir, for around 70%. Can you elaborate on why qualitative assessments are more important than numbers alone in identifying long-term compounders?
Absolutely. So this is a very good question. See, what happens is, as I was mentioning, quantitative factors often is more like a science. You have a number, you can like put some criterias around it, and in a way it works like a science. But the qualitative aspect, like say trying to assess the management, trying to assess the capital allocation style of what they have done in the past, or how do you assess the growth hunger for a management? A lot of these things, whether to assess that whether a moat is expanding or declining, what would be the growth, the scale opportunity, what are the kind of optionality which is there. Some of these things you cannot get on a backward number or through numbers itself. So for that you have to focus more on the qualitative aspects. And when you are focusing on qualitative aspects, it's an art, so it's very individual driven, so it's something people cannot copy. So to that extent, there is some kind of a sustainable competitive advantage here, because if you're doing something which is very quant driven, then at some point or the other people can figure out, and your differentiation can go away. But if the differentiation is coming from something which is very inherent or individual specific, or through a system or a framework specific, then you have a big advantage.
Yeah, got it, sir. So there is a question from audience, sir. He has asked some stock specific questions. If you are okay, you can address it. DMart
I
has enjoyed cost advantage but tends to lose market share to quick commerce. So how do you tackle this slowdown of growth? He is asking about brick and mortar commerce. This is quick commerce, sir, and loss of market share.
So yes, so one of the example is there is one large organized retail which is listed, and they have gone on record saying that the quick commerce is at most impacting their growth by 1% and all, and it is not much. So when people look at contrasting segments in a market, they assume if one is growing, it has to be at the cost of other. But let me just give you a perspective. If the overall organized retail market is say 750, 800 billion dollars, then quick commerce within the organized retail within that is say hardly 8-9%. In fact, the organized grocery market would be like 7-7.5%. Whereas when you talk in terms of even the convenience or the quick commerce, the convenience business as you call it, that would also be something roughly in a less than that. It would be more like a 6% and so on. So the bulk of the market that you are competing against is the mom and pop stores. which currently today have no competitive advantage. In fact, they are losing, or the smaller organized plays. So you are not necessarily, if the question was that if an industry is 100 and both of them are trying to earn out of the growth, that is if 100 becomes 108, both are depending on that growth to earn their business. That is not the case. The business here is that within a pizza itself, you're trying to gain market share. So if the pie is a $750 billion, you are currently growing within that only. You are taking market share from the mom and pop or the so-called the smaller organized segments and so on. So I think they are both contrasting segments. One is a convenience one where you are willing to pay a significant premium for someone to come and give home delivery, whereas the other is aimed at a segment which values money a lot, which is a value investor, which is a value buyer, and he would take pains to save that 100 rupees. So they are two contrasting markets. While in the very urban area, they could have little bit of overlap, but then there again, the comparison you would do is more with the e-com part of that particular retailer rather than the brick and mortar player. So as it is, many of these discount retailers, they don't sit in the main heart of the city. They are more in the suburbs or the tier two, tier three. In the tier two, tier three, to have people who would be like willing to pay significantly for convenience is also lacking. So I think there's room for both the players. The best part is even in the convenience or the quick commerce, there are hardly two, three players who are ruling the roost. The same in the organized retail, there are hardly two, three very large players. So you are talking of a very large market with two, three very companies with significant advantage. So I think both of them can keep growing, and they don't have to necessarily. Growth of one does not necessarily mean that you're negating or eating into other one's market.
Yeah, understood, sir. So I think we have come to the end of the session, sir. The remaining audience question we will share it to you so that your team can answer them, sir.
Great. Thank you so much for your time. Really appreciate your taking time out for this webinar, and look forward to any questions, and happy to answer on that. Thank you so
Yeah,
much.
thank you so much, sir. We have learned a lot from your presentation, sir. Yeah,
Thank you so much.
thank you. Thank you all.